Hello, students, and hello, everyone. This is Teacher Angel, and welcome back to our accounting online video lessons. For today, our lesson is a continuation of our previous video lesson on the introduction to bonds payable. So today, I will be discussing to you the procedures and accounting treatment for the issuance of bonds. So at the end of this lesson, the student should be able to record the issuance of bonds through memorandum approach and journal entry approach, account for the issuance of bonds at a premium, account for the issuance of bonds at a discount, and record issuance of bonds between interest dates. So for the specific topics, we have the accounting for authorization and issuance of bonds, issuance of bonds at a premium or discount, presentation of bond discount and premium, issuance of bonds on interest date, and also issuance of bonds between interest dates. So let's start with the first topic. We have the accounting for authorization and issuance of bonds. So there are two approaches in accounting for the bond authorization and issuance. We have the memorandum approach and we have the journal entry approach. So as what their names suggest, so when we use the memorandum approach, the authorization of the bonds will be written or recorded through a memorandum entry, wherein you're going to describe the authorization, the specifics and details of the authorization. Meanwhile, if that is journal entry approach, you have to prepare a journal entry for the authorization of the bonds. So to illustrate, we have here a problem. On January 1, 2021, an entity is authorized to issue 10-year 12% bonds with a face amount of 5 million. Interest payable on January 1 and July 1. So therefore, the interest is semi-annual because it's twice a year, consisting of 5,000 units of 1,000 pesos face amount. The bonds are sold at face amount to an underwriter. So if you can recall, the underwriter is the middleman between the issuer and the investor, and usually the underwriter is an investment bank. So to record the authorization of the bonds using the memorandum approach, so you have to prepare a memorandum entry as follows. On January 1, 2021, the entity is authorized to issue 5 million pesos face amount, 10-year, 12% bonds, interest payable on January 1 and July 1, consisting of 5,000 units of 1,000 pesos face amount. And to record the issuance of the bonds, so you debit cash, 5 million, and credit bonds payable. If that is a journal entry method, the difference between the two first is that in the authorization of the bonds, an entry will be prepared. Unlike in the memo entry wherein you have to prepare only a description through memorandum entry. So this time, if it's journal entry approach, then you have to prepare a journal entry. So the entry would be debit to unissued bonds payable and credit authorized bonds payable 5 million. Another difference between the two approaches is that when you record the issuance of the bonds, you have to use the appropriate accounting title. Previously, the credit is bonds payable, but since we have a debit to unissued bonds payable, that's also the account title that you're going to use to issue the bonds. So credit unissued bonds payable. So all throughout the examples here or the illustrations for the bonds payable accounting, we will be using the memorandum approach. Now let's go to the issuance of bonds at a premium or discount. So what is a premium? What would be a discount? How do we know if it's a premium? How do we know if it's a discount? So you will know that it's a premium when the issue price or the consideration we received, ang money na receive or ang money na nadawat nato from the sale of the bonds or issuance of the bonds is greater than the face amount of the bonds. And we already know what's the face amount, diba? That's the specified total value of the denominated bonds. So if the issue price is greater than the face amount of the bonds, there's a premium. Another indicator that it's a premium if the effective rate is lesser than the nominal rate. Okay? You'll know later in the effective interest method that there are two rates that would be presented in the problem. There would be an effective rate and there would also be a nominal rate. So one indicator is that if the nominal rate is greater, or vice versa, the effective rate is lesser than the nominal rate, then that's a premium. So the premium on bonds payable is in effect a gain on the part of the issuing entity because it receives more than what it is obligated to pay under the terms of the bond issue. Remember, the issue price or the amount that we receive is greater than the face amount. So, dako taog na receive na money compared sa dapat natong bayaran, which is the amount represented by the face value or the face amount of the bonds. The obligation of the issuing entity is limited only to the face amount of the bonds payable. However, the premium is not reported as outright gain, meaning you will not record the amount or the difference between the issue price and the face amount as a credit to a gain or credit to income. It's not the case. You have to record it using the appropriate account title, which is premium on bonds payable. On the other hand, if it is a discount, opposite to the premium. So there is a discount if the issue price is lesser than the face amount of the bonds. Meaning, we received less. Gamay taog na receive ng money compared sa face amount of the bonds. Another indicator is that the effective rate is greater than the nominal rate. So this is opposite of the premium. So the discount on bonds payable is in effect a loss on the part of the issuing entity because it receives less than what it is obligated to pay under the terms of the bond issue. However, the same with the premium, you're not going to record the discount or the premium as a loss or a gain. You're not going to record the discount here as an outright loss, but you have to use the appropriate account to record the difference between the issue price and the face amount. And the appropriate account title would be discount on bonds payable. When bonds are sold at a discount, it means that buyer or investor is not willing to accept simply the nominal rate. Accounting-wise, the discount on bonds payable is amortized as loss over the life of the bonds payable and charged to interest expense. So to illustrate, okay, so we have the following, the premium and the bonds. For the premium, you have an example here. An entity issued bonds payable with face amount of 5 million at 105. What does this mean, this 105? It means 105%. 105% of the face amount of the bonds. So how would this be recorded? So debit cash, that's 5 million times 105% or 1.05 if we're going to use the decimal. So that is 5,250,000. And credit the face amount of 5 million, and the difference between the 5,250,000 and 5 million is 250,000. The balancing figure is on the credit side, so that is recorded as premium on bonds payable. Therefore, the normal balance for a premium on bonds payable is a credit balance. Now let's go to the discount. So for example, an entity issued bonds payable with face amount of 5 million at 95. So the quoted price of 95 means 95% of the face amount of the bonds. So what is 95% of 5 million? So that's debit to cash 4,750,000. That's 95% of 5 million. Then credit the bonds payable of 5 million, and the balancing figure is on the debit side, 250,000, and the debited amount would be recorded as discount on bonds payable. Therefore, the discount on bonds payable has a debit balance. Then in the problems, you might encounter bond issue costs. So these are transaction costs directly attributable to the issue of the bonds payable. This include printing and engraving cost, legal and accounting fee, registration fee with regulatory authorities, commission paid to agents and underwriters, and other similar charges. And how do we treat the bond issue costs? Under PFRS 9, the bond issue cost shall be deducted from the fair value or issue price of the bonds payable in measuring initially the bonds payable. If the bonds payable are measured at amortized cost, remember that there are two subsequent measurements for the bonds. We have the bonds measured at amortized cost using effective interest method, and we also have the bonds issued at fair value through profit or loss. So for the first category, bonds that are measured at amortized cost, the bond issue cost must be lumped with the discount on bonds payable, meaning you are going to add this to the discount. And when we say netted against, so the bond issue cost will be deducted from the premium on bonds payable. Then bonds measured at fair value through profit or loss. So if the bonds are measured at fair value through profit or loss, the bond issue costs are expensed outright. They are not included in the value of your bonds payable. How do we present the bond discount and the premium? So the premium on bonds payable will be added to the face amount of the bonds. For example, you have 5 million plus 250,000, so that's 5,250,000. If it is a discount, the discount will be deducted from the face amount to get the carrying amount. So the carrying amount of the first given scenario is 5,250,000, and for the second one you have 4,750,000. Then how do we record transactions for issuance of bonds on interest date? So what do you mean by recording interest of bonds on the interest date? So the transaction or the initial entry happened on the interest date mismo. Okay, before we proceed to that, let us see how do we record the interest on the bonds. You have illustration. On March 1, 2021, an entity issued bonds payable with face amount of 5 million and 12% interest payable semi-annually on March 1 and September 1. Inasmuch as the bonds are issued on March 1, 2021, the first payment of interest will be on September 1, 2021. So for year 2021, to record the issuance of bonds, we debit cash 5 million and credit bonds payable 5 million. For this example, it is issued at face amount. So walay premium, walay discount. So the first interest payment would be on September 1. So to record the semi-annual interest, debit interest expense, then credit cash. So that's 5 million times 12% times 6 over 12. Because that would be only a half-year interest from March 1 until September 1 of 2021. Next, we have to record the interest on December 31. Remember that we have to accrue the interest every year, and even if it is not the complete period for the interest, diba? The interest is payable every 6 months. So from September to December 31, it's not a complete semi-annual. That's only September, October, November, December. That's only 4 months. But still, we have to accrue because the time has expired. So, na expired portion, so na interest nga na-incur for 4 months. So, how much would be the interest accrued? So, that would be 5 million times 12% times 4 over 12. 4 over 12 because 12% is for 1 year and the time that lapsed is 4 months from September 1 to December 31, and 12 ang ato ang gamiton because again 12% is good for 1 year interest. So debit interest expense 200,000. Then credit interest payable, or you can also use accrued interest payable, 200,000. Then for year 2022, we have to reverse the entry made last December 31. So, diba, going back on December 31, we accrued interest expense, interest payable. So, on January 1, we have to record the reversing entry. So, debit interest payable, credit interest expense. You just simply reverse the entry. The account debited on December 31 will be credited on January 1, and the account credited on December 31 will be debited on January 1. Then next is record the semi-annual interest on March 1. So that's already good for 6 months from September 1, 2021 to March 1, 2022. So you're going to record the whole amount of 300,000, which was good for 6 months. Why? Because we have prepared a reversing entry on January 1. In effect, when we record this item here, unya na na-credit daan nga 200,000, in effect, ang net interest expense ko to March 1 is 100,000, which is actually the interest good for, that's only good for 2 months. Okay, let's check. 5 million times 12% times 2 over 12. That's 100,000. Nga lang 2 months man, ma'am. Because the time lapsed from January 1, 2022 until March 1, 2022 is 2 months. So, maoragid siya ang interest expense good for 2 months. And what is the interest for 2 months? That's 5 million times 12% times 2 over 12, which is 100,000. If you're going to get the net amount here, 300,000 debited to interest expense and interest expense credited nga 200,000, that's net 100,000. So, this is the appropriate entry in order to get the exact interest expense as of March 1. Then, for September 1, that's the semi-annual interest date again. So, that's interest expense, 300,000 credit cash. And on December 31, again, we have to accrue the interest from September 1 until December 31. So that's 5 million times 12% times 4 over 12. So that's from September until December, 4 months. Okay, another illustration. On June 1, 2021, an entity issued bonds with face amount of 5 million at 97. So this time, there is a discount. Why is it a discount? Because the face amount is 5 million and the percentage here is 97. So it's less than 1. So there's a discount. So 5 years to pay with 12% interest semi-annually on June 1 and December 1. Is it always the case, ma'am, na semi-annual siya? No. The interest can also be monthly. The interest can also be annually. For this problem, straight line method is used for amortization. So for 2021, the entry would be for June 1. This is the issuance date. Cash, that's 5 million times 97%. So it's 4,850,000. Debit discount on bonds payable, 150,000. And credit bonds payable, 5 million. Next is on December 1. This is the first, okay, that's the first interest payment because the June 1 is the issuance date, which is also the interest date, diba? The interest date is June 1 and December 1. So therefore, the first interest date is on December 1. So you're going to record the interest. So debit interest expense, credit cash, that's 5 million times 12% times 6 over 12. Again, why is it 6 over 12? Because the interest is paid on semi-annual and complete niya ang 6 months from June to December 1. On December 31, we have to accrue a portion of the interest because the next interest payment would be June 1 of 2022 pa. So, mabuo ang 6 months ini ka June 1, 2022. But, from December 1 until December 31, na may ma-expire nga 1 month. So, therefore, compute the interest for 1 month, 5 million times 12% times 1 over 12. And since there's a discount, we have to amortize. How do we amortize? That's using straight line method. Later on, you will learn how to amortize using the effective interest method. For now, we use the straight line method. So how do we get the amortization? So it's 150,000. That is your discount here. Divide it by 5. That's 5 years because the term is 5 years. Times 7 over 12. Why 7 over 12? You count from June 1 until December 31. So June, July, August, September, October, November, December. That's 7 months. 7 over 12. Again, divided by 12 because the answer here, 150,000 divided by 5 is 30,000, good for 1 year. And to get the fraction, so times 7 over 12, that's 17,500. So in effect, so the discount amortization will reduce your balance of discount here. Guys, 150 debit, then 17.5 credit, so ma-deduct na siya. For year 2022, on January 1, you're going to reverse the entry here. So, interest payable, credit interest expense. And then, on June 1, you're going to record one whole semi-annual. Tibuok nga semi-annual, dili ra fraction. The same explanation earlier. I-whole nimo siya because anyway, madidak man tong for the amount in the reversing entry. So, kanin siya ma-deduct siya. That's 250,000. If you're going to compute from January to June 1, so January, February, March, April, May, that's 5 months. That's 5 million times 12% times 5 over 12. That's 250,000, which is sakto. Diba? January to June, 250,000. Pag imuhan ning in-net, this is also 250,000. Next, on December 1, you're going to record again the semi-annual interest. So it's good for 6 months again, the same with the entry here. And on December 31, record again an accrual of the interest. So that would be good for 1 month. So that's 50,000 again. And for the amortization, since dili naman siya fraction, kay mag-start naman kita from January until December. So that's 150,000 divided by 5 years. So that's 30,000 whole. So debit interest expense, credit, discount on bonds, payable. Then, how do we present the carrying amount of the bond? So, same problem gihapon ni siya, but we're going to present what is the carrying amount of the bonds in 2021. For 2021, that's 5 million face amount bonds and the balance of your discount on bonds payable, 132,500. Where did we get that? So, that's from 150,000 debit and credit 17,500. So i-minus kay they are not of the same balance. So the balance for the discount is 132,500. Get the difference. The carrying amount of the bonds on December 31, 2021 is 4,687,500. In 2022, since there is further deduction from the discount by 30,000, so 132,500 minus 30,000, so that's 102,500. So the remaining discount is 102,500. Deduct that from 5 million, you will get 4,897,500. Next is you have issuance of bonds between interest dates, meaning ang date kung kano sa gi-issue ang bonds, wala mo coincide, wala mo tunong sa interest date. What does it mean? So for example, on April 1, 2021, an entity issued bonds payable with face amount of 5 million at 5,228,000 plus accrued interest. As you can see, the issue price, this is the issue price, and this is the face amount. The issue price is greater than the face amount, so there is a premium. The bonds are dated, this is dated, January 1, 2021, maturing in 5 years, and pay 12% interest semi-annually on January 1 and July 1. The interest dates are January 1 and July 1, but the issuance date is April 1. So, man itong issuance of bonds between interest dates. So, wala siya mutunong sa January o sa July 1 interest dates. So, what will be the entry? To record the issuance of bonds, we have to debit cash for the proceeds. How do we get this proceeds? 5,378,000. Wala man siya sa problem. Ingon diri, 5,228 plus accrued interest. So, you have to compute the accrued interest. That's 150,000. That's 5 million times 12% times 3 over 12. So how do we record, or how do we compute? How do we know kung pila ka months? So from where man ta mag-count? So you have to check here when is your issuance date. The issuance date is on April 1, which is in between January 1 and July 1. Naa sa taliwa sa January 1 and July 1. What you're going to do is you have to look at the date between January 1 and July 1. Tanawin mo ang date asaan na ang immediately preceding April 1. Asa man sa January 1 o sa July 1 ang nag-una sa April 1. Asa man nga date ang nag-una sa April 1? Nag-una ang January. So therefore, your count is from January 1 until April 1. Again, how do I know, ma'am, kung pila ka months? You have to count the months from the interest date, which is immediately preceding the issuance date. Between January 1 and July 1, which date immediately precedes April 1? So, ang nag-una sa April 1 or before mahitabong April 1 mo agi sa taog January 1. So, ani ka mag-start of count? January until April. So, January until April is January, February, March. So, that's 3 months. Okay? So that's how you're going to count the months. So that's 3 months, so 3 over 12. And then the answer here, the accrued interest will be added to 5,228 because ang gigon dire plus accrued interest. So 5,378,000. Credit bonds payable, which is at face amount gid ang i-credit ana. Di yun nakalimtan ha. Pag mag-credit ganitag bonds payable, face amount yun na siya. Bisan pag premium, bisan pa og discount. Then, record the premium on bonds payable, the difference between the face amount and the issue price, 228,000. And record separately the interest expense of 150,000 credit. Diba nga naman tong entry nato pag niagi, diba? Credit to interest expense tong na ay recording of the interest, and also when you reverse the entries. Now, to record the semi-annual interest, when will we record the first semi-annual interest? Since nilabay naman ng January, dili naman ta pwede mag-retro ani na ta sa July. So, debit interest expense, 300,000, credit cash, 300,000. So, that's 5 million times 12% times 6/12. Okay, next is I'm going to illustrate to you the alternative approach. This is the same problem with what I have presented just a while ago, but there would be an alternative way on how to record the interest expense. So again, this is the same answer ganiha. The alternative way to record a transaction is instead of crediting interest expense, you're crediting interest payable. So this is the alternative approach. So when you record the semi-annual interest, you debit interest payable 150,000. So i-close siya. Then debit interest expense 150, and then credit cash 300,000. Why is it that the interest expense here is 150, ma'am? Okay, why 150? Because from April to July, April, May, June, that's only 3 months ang na-lapse. Okay, so 3 months are good ang interest expense. And kaning 150 nga, debit nga interest payable, that is closing your 150,000. Pero in effect, parehas ra gyud siya sa previous nga presentation. Katong presentation ganiha, kani, para sa gina siya, 150 gihapon ang net nga interest expense. Interest expense, 150. Debit, interest expense, 300. So, 150,000. Net interest expense. Okay, next is, let's continue. Same problem. Again, same problem. Let's go back to the original presentation using the interest expense, but we will continue the problem until December. So, December 31, interest expense, credit, interest payable. Nga interest payable man siya, ma'am. Nga kung imong computon, July until December 31 is 6 months, di ba? July, August, September, October, November, December, that's 6 months, ma'am. Ano dili man cash? Remember that the payment date is every January 1. So, even if 6 months na siya, kutob December 31, but you're not going to pay on December 31. You're going to pay on January. So still, on December 31, you still have an interest payable. Wala pa siya nabayaran. Kano saan man siya mabayaran? On January 1. Okay? That's why interest payable diri. So, dili porket ugma na ang tingbayad, you're going to credit cash because as of December 31, good, no payment has been made. Then to record the amortization on December 31, debit premium on bonds payable, then credit interest expense. That's 9 months times 4,000 pesos. So how do we get the 4,000 pesos? So the original life of the bonds is 60 months. That's 5 years times 12. Okay, diba? 5 years man ang utang. And then the expired life from January to April. Diba, January ang date, interest date immediately preceding the issuance date. So, na ay 3 months nang nilapse. So, 57 months ang nahabilin. So, your premium of 228,000 will be divided by 57 months, and that would be 4,000 per month. And how many months naman? From April to December 31. So April, May, June, July, August, September, October, November, December. That's 9 months. So 9 months times 4,000.
If you like this video, don't forget to click like, subscribe, and hit the notification bell to be updated with the latest video lessons. Thank you for watching.